Alrighty, let's start it up. As usual, Sunday morning weekly market recap. And again, apologies in advance for my silly voice. I'm a little bit under the weather. Once again, it's becoming a little bit of a theme in this autumn of 2024. And I guess the reason is always the same. Me keeping on refusing, probably, the turn of the season and especially my own come of age and keeping on acting like I'm a young 20-year boy, doing stuff outside with just a t-shirt on, and then, of course, suffering the consequences of it. But with that out of the way, let's jump in the usual economic calendar for the past week. I just discovered you can have the charts for the data you want to look at already expanded instead of having to expand each one of them while you're scrolling through. So that is good. I just learned a new thing as a boomer, right? Now, what do we see? Now, we had a few data points kind of important, I guess. Like we got the always important CPI print, and we know the next CPI is always the most important of all time, of course. And what can we see is basically CPI month over month came in at 0.2, not surprising, but more on that in a minute. The core stayed at zero point 0.3, and we are still averaging some. What was that? Well, still, this is the month over month, so you can't really see the year over year. I'm not sure if it is provided here. You got it for the CPI, but it looks like we don't have it for the core, I guess. No. Anyway, it should be around 3 point something. I don't remember if it was 3.6 or something like it. Overall CPI year over year is hovering around 2.4. It was expected 2.3, and the previous was 2.5. So, I mean, a little bit hotter than expected, but not zero point 0.1 deviation from the forecast. It's not that big of a deal in my view. The trend, you can clearly see it's still down. So I think we are still in disinflation, but have a few considerations about that, about the debate which is currently going on in markets and especially in market commentaries. I got a little bit of opinion on that, but more than that, when we are gonna dive into what happened with yields and bonds, right? Unemployment claims came in really high, but if you follow the recent events, you do know that basically a decent part of the US have been hit by two consecutive hurricanes. I guess they were Helen and Milton. So, a spike in the claims like these could be justified by, of course, people having to use the unemployment claims because, of course, if your region is hit by an hurricane, most likely you're not going to be able to work, whatever job you're actually employed in, right? So it could be a little bit of that. It could be a little bit of a seasonality adjustment. So again, I wouldn't read a lot into it. If not, just if you look at the 2024 trend, it was going up. Then you had this little bit of a pullback throughout the summer. Again, could be seasonality, holiday season. People just move around, they travel more, and so might be that, especially in leisure and hospitalities, they need to hire more in order to face this kind of surge or temporary surge in demand. It could be a little bit like that. Uh, there is just one thing I wanted to point out, and it's not directly related to jobless claims, but it's more about kind of taking a little bit of a step back to what came out previously as for NFP. That was interesting to me. Uh, I think, just read the text because it might explain that way better than I could do. But it basically shows you that if you factor in the seasonal adjustments, you see that the um, seasonal factor, which kicked in the last print, was the highest on record or kind of like that. I mean, it says since 1948, so I guess it's a huge time span over there, right? Um, and it also with this chart, I guess this is by Zero Edge, if I'm not mistaken, but it shows you that the amount of government job added was the highest on record. Now, again, scrolling down, you got average weekly hours of all employees, and you see it's still declining. So, although the data at face value could sound like a booming economy, roaring economy type of data, because it basically crashed expectations. It came in at 254, I guess, expected 145, so completely smashed expectations. But if you dig underneath the surface, you see that a few things here and there are not really heading up, especially when it comes down to the fact that a huge percentage of that increase was due to government hiring. Now, I wouldn't like to get or to turn the whole analysis in some sort of a political type of debate, but you know, just objectively, if you consider that when the government is hiring, and I would say at a point you start wondering what, why are they hiring so many people? What do they do? Because it looks like many of the employed in the public sector are just sitting there idling, not really doing nothing, but they're getting out a wage off of that work, right? And you need to consider that the difference in between the private sector and the public sector when it comes down to hiring, right? If you run your own private business, in order to justify hiring new people, you need to have the revenues for it. Otherwise, you're not going to be able to generate the cash flow to pay out those salaries and wages. But for the government, that problem doesn't exist. They can just pay them with free printed money out of thin air. So it begs the question of, in a growing and healthy economy, you would like to see the majority of the new jobs added by the private sector, because it would show you that the private sector is good and the real economy is good. If you see the opposite of that, it doesn't necessarily tell you that everything is going fine. And again, if you want to be a little bit sarcastic or a little bit political, you might say, well, we are like 3 weeks away from election now. Wouldn't be that kind of a stretch of imagination thinking that maybe the government is trying to hire many, many people just to fudge the numbers here and depicting some sort of a situation which is way better than what it really is, just to kind of gain consensus. Could this be? Could this not be? Who knows, right? Or okay, I'll just say I think it is, right? There you go. There you go. It's kind of the same with how they revised the GDI numbers. So if you look at the revised figures now, it looks like that huge gap in between GDI and GDP, it doesn't exist any longer. Again, are they cooking the books there? Probably. I mean, I think so. Moving along, there was what then? The PPI and core PPI, they came in line with current trend and basically in line with expectations, right? So nothing new there. Just these were the main data points coming in for this week. There wasn't really anything more, and I guess this is already enough, right? Now after that, let's move on a little bit because we are in earning seasons right now. Okay, so if you look, these are the futures for the four major indices in the US. Like you got your usual Nasdaq, the S&P, the Dow, and of course the Russell. So a little bit of a small caps too, right? Uh, Fun fact: S&P is still leading the way together with the Dow. Nasdaq is lagging a little bit, but it looks like finally decided to follow up. And of course, as you expect, the small caps are just underperforming. But you know, we discussed that it's kind of like in the nature of small caps underperforming the mega caps. That's for sure. We are also in earning seasons now. I guess if I'm not mistaken, next week you're gonna have earnings report from the big techs, sorry, big tech stocks. But there was something kind of, don't know if I should define it curious or interesting or whatever, but about earnings, what can you see is that it looks like the game, even in this field, is a little bit kind of, I don't want to say rigged, but it's structured in a way which tend to to bring up positive results when it comes down to stock and equities returns. So basically, you see that estimates are continuously revised lower so that it's easier to beat expectations and therefore having a little bit of a positive response when it comes down to the price of the underlying stock, right? Which is why it's defined millennial earning season. It's kind of like what we are living through right now in our current times and age. Everyone gets a trophy because the standard is always lowered. So it's kind of like the participation prize that you get, not because you put in the effort or the time or the sweat or the blood, but just because you participated in, which, over time, both for stocks, financial markets, and society at large, I think it's a huge drag on future growth and prosperity. But, anyway. And, conversely, you see the percentage of S&P companies which is actually beating the earning forecast, right? This is just a reflection of the dynamic described in here. Now, what's interesting is that if you see the trend, if you look at the trend, you can see that this is basically comparing 2023 and 2024 estimates versus actual earnings, right? Basically, you see the same pattern. 2023 earnings from March to October, they were revised lower, and kind of the same if you compare March 24 with October 24 dashed green versus dashed orange. You can see how they've been revised lower. So again, this is just something which shows you that over the long run, although you might make things looking better than what they really are, but over time these earnings grow. It's this growth. It's kind of unsustainable at a point, right? And it doesn't have to be tomorrow, next week, next month, next quarter, but it will come to an end. Um, there's just one important distinction, right? Because I see people are kind of making up this parallel in between the dot-com bust in 2000, in the early 2000s, and what's happening now. There is a huge fundamental difference there that you need to consider. Throughout the dot-com bust, those companies, they weren't actually generating revenues. If you actually look at Google, Nvidia, and whatnot, this time around, they're actually generating revenues. So to me, it's kind of useful and disingenuous to compare the two periods because fundamentally things are completely different. So just to be a little bit more objective and not being carried away by a narrative. All right. Okay. Although, all things considered, when you look at it, the estimates are really deviating to the upside in this case from the reality of economics. And again, it doesn't have to be now, today, or tomorrow, or next quarter, but at a point you're gonna have to see a little bit of a readjustment when it comes down to the price of the stocks and equities, and therefore, the overall index for equities toward what real economic factors are. So just bear it in mind. The more something is deviated out from, it could be long-term moving averages and whatnot, the more you're gonna have a little bit of a mean reversion. And we went onto this topic last week while looking at the price of gold, right? If you remember that chart, and even stocks, they are trading at two, three, four standard deviations compared to long-term averages. So, at a point you're gonna expect a little bit of a mean reversion. Same goes for everything. All right. Now, this last chart, and then I'm done with this earnings topic. It shows you that uh, what you got is the reflection in between earnings and the real gross domestic product, right? And the basically the revenues after you have adjusted and accounted for the taxations and whatnot, and it's compared to the price of the S&P 500. What you can see is that the the growth, so the price appreciation of the index, has been completely phenomenal over the last 2 years. I think we are up 54% in 2 years, which is, if you compare it to long-term average returns, it's just out of the blue, right? It's incredible. Um, so the problem with that is that at a point, these two will have to mean revert, because if you look at the real gross domestic product, and again, real is usually adjusted for inflation, you see that it is on a downtrend trajectory. Now, of course, you got this bip right here, 2020, because of the stimulus, the PPP, UBI, and all those measures implemented by the government, sending checks to households um, in response to the pandemic. So you see this little bit of an outlier here. There's a little bit of anomaly, but all of that will come to an end. I mean, all the stimulus, sooner or later, they will be out of the system. It's like, when you see the metaphor of the python, sorry, of the mouse into the python, right? It digests it very, very slowly, but at a point, that mouse is going to be out of the python. And that's where you get back to a more normalized type of, in this case, economy, and therefore stock market return. See, since at the end of it, you know, stocks evaluations should be a reflection of price to earnings and whatnot. So everything comes down to earnings. If those companies are not able to generate earnings or to grow, most importantly, grow earnings at the same pace, you will need to reassess the evaluation that you are making of the stocks for the company, right? So that was it for earnings, since we are in earnings season. After that, just jump in to the charts. Let's start out with the currencies. Uh, you got a little bit of an uptick in the DXY, and conversely, the euro came back down, the pound, the yen, everything came back down on the back of these bounds in the DXY. Uh, it was maybe unexpected, right? Because we have always talked about this long-term macro range, and it was looking like it might be at this point we really break down from this range, and probably the XY should fall down to the high 90s and whatnot. Looks like we didn't. And this is a setup which is, I mean, it's counterintuitive, but it's always cool to see that. It's kind of like with oil. You remember oil? We were talking about the positioning, the bearish sentiment, and oil spiked despite even before factoring in what happened in the Middle East, but it just spiked. Kind of the same with the DXY right here. Um, I don't have charts for it, but we also saw a little bit of a spike in the repo markets. So it looks like there was a little bit of turmoil there. And of course, when you got the money market going a little bit high wire, you might have a little bit of a spike in dollar, because it tells you the same of every single time. It's a little bit of a scramble for liquidity. And although, overall liquidity conditions remain particularly stable for now, there is always that risk brewing underneath the surface. Like you see, for example, like when we got in March 2023, that kind of a banking crisis with regional banks taking the chance of going under, you see kind of the same precursors of that type of dynamic, because I've seen that the loans taken out from the, what was that, the federal home loans something, actually spiked up. So it's like some banks might be into trouble a little bit when it comes down to liquidity, and instead of going to the discount window, they go to the Federal Home Loan Bank because that way they can avoid the stigma that going to the discount window that the Fed actually brings. So again, the Fed doesn't like it. They would prefer banks to come to the Fed actually and use the discount window. But the problem is that since everything revolves around counterparty risk and perceived counterparty risk, when a bank is going to the Fed, it's basically admitting that they got issues with their balance sheets, and maybe the other banks at that point won't be willing to deal with them, exacerbating the problem. But if you go to the Federal Home Loan Bank, the stigma is not there. So it's an interesting dynamic anyway. Let's take a look at gold again. Gold keeps on climbing higher. It had a little bit of a pullback right in here, and I remember I was talking about this a little bit of extreme positioning into gold, kind of like in oil, but just to the in the opposite direction. But again, it looks like we got a little bit of a nice bounce in here. Now it remains to be seen if this bounce would be sustained or not. So far, it looks like it might be. I mean, I personally do like this close on a Friday. Let's zoom out on the weekly time frame. We basically tapped back into this inefficient segment right here, and we closed the week as how would you define that? A doji, a long leg doji with the leg to the downside. So if you got continuation to the upside next week, that should be good, right? But again, still just looking at the trend, higher highs, higher lows, higher highs, higher lows. We worked out our recent higher lows, and now we need a new higher high. So basically above 2,700, more or less. Oil, again, a little bit of a spike on the back of what happened in the Middle East, positioning, everything we discussed. We took out this high right here and we immediately pulled back quite a lot. But now price is stable in this new dealing range and it looks like it's, would you say it's poised to go up? I'm not sure. I mean, I'd like to say it's not, but let's look at these, for instance. Where was it? All right, the break evens are actually particularly close to that inflection point I was looking at. So could this be a change in the trend confirmed by some fundamentals indicator? Um, Maybe. I guess at least, this tells you need to be on a high watch for it. Um, Still, the 5, so the red line is still below the 10, but this is a very delicate situation. If you take these all kind of indicator or metric in isolation. Then you would need, of course, to pair it up with the actual price on the chart because the best use you can make of it is actually spotting divergences, right? But I would remain particularly neutral on oil up until the point it is closing below this level right here, but still above this fractal right here. It's not perfectly similar, but it's kind of like what we've seen on Bitcoin. Let's just transition to Bitcoin, so it might be much clearer, right? So basically, what you see in Bitcoin right in here for now, at least, is a little bit of a trapped fractal, right? So price is stuck in between these bullish fractal right here and these bearish fractal right here. Kind of like we got previously. There was this bearish fractal right in here, and price really struggled to break above. But at the same time, you got this bullish fractal right here, and price bounce off of it to the upside. That's one, two, right? It was stuck in this range for a little bit of time. So again, even on Bitcoin, I do remain a bit neutral now. It's it's looking kind of good, right? At least it's not going for new lows, which is important after you make new highs, or at least relatively new highs compared to this intermediate high right here. Um, Look, I got some pushbacks, but I still look at Bitcoin sometimes in relationship to what other risk on assets are doing, mainly the stock market, and the S&P is particularly bullish now. So if I'm bullish on the S&P, I can't be full on bearish on Bitcoin. I mean, I know they are not moving in locksteps, but overall, as a general type of a perspective in this position, it's hard for me to be bullish the S&P and being bearish Bitcoin because they should move kind of together. There should be a little bit of a correlation there. Again, it doesn't have to be in locksteps, but I still see them as risk on assets. I do also think that Bitcoin is much more, it's much riskier compared to the S&P due to the implied volatility of Bitcoin compared to the S&P. So what I would do is going off the premise that if you are going to see weakness, probably Bitcoin will be the first to be weak, and the opposite stands right. If you are going to see strength, the S&P should be the first to manifest strength, and Bitcoin should follow up. Again, it's not going to be like that every single time, every single day, every single week, but generally speaking, that's what I would expect from a macro perspective. All right. Let's transition into yields, treasury yields for the United States. Again, these are coming up quite sharply, should I say, but it's noticeable, especially in the long end. They are coming up sharply into what you could deem as resistance at this point. See this kind of an apex right here. It's kind of the same here. Although the 2 years actually almost passed that. In this case, it shouldn't really be an apex. It looks more like a shelf, but I still see them in a precarious situation, so to speak. Like yeah, they're coming up, and technically you should be paying attention to it. And if you like me have positions in the underlying asset, you should manage your risk at this point, which I did. I unloaded a little bit of that, 30% of it, because we got that Saturday news event, right? But I still think that long-term interest rates are set to be lower. Now, I know it is a very kind of debatable type of thesis, but it's just for me that there is no fundamental reason for interest rates to go up. Like, yeah, unless you got an inflationary revamp, I don't think there is, and I don't think there is. We got the case for a reinflation or inflation be reignited at the current moment in time. And let's look at these charts for a minute, right? Now you see this is the 10-year, for instance, right? And the 12, 200 days moving average. Now you can see that now we are living below it, and this sharp move to the upside could be just a retest of the average and this current apex that we were looking at on the trading view chart. So as long as we are below it, I might maintain my stand that interest rates should go down. Because you've seen in the past, once we break above it, it goes up. Once we break below it, it goes down. And here and here to the upside again. Now again, moving averages, they are not perfect, right? Look at this period, for instance, or look at these, or look at these. It's no perfect tool, and by the nature of it, it is an average, so price naturally have to trade above and below it, otherwise it couldn't be an average. But at the current moment in time, I would take it like it. That would be my take on it. And especially if you look at these, which might look a little bit confusing. You got a lot of different indicators. You got MACD on the top panel. You got a stochastic on the middle panel, and you got percentage R. I don't even know what that is, to be fair. I was more interested in what you get on the actual price chart, right? So basically, what you see here is that coming into Fed meeting where we basically seeing the Fed pivoting, price was really deviated to the upside if you look at the standard deviation from long-term averages, right? Um, and now, conversely, we are deviated to the downside to those same standard deviations. So what I would expect is again a mean reversion type of a trade, so a little bit of a bounce to the upside from this region. Could be next week, could be next month. I don't even know if it's gonna take the entire month of October, but standing to this chart and standing to the pattern, I think that's where bonds should travel next. So a little bit of a pullback in yields and a little bit of an upside on bonds, at least for a bounce, and then we reassess. But it is just based on standard deviation concepts, right? And again, why do why do you think yields are set to be down? Because I've always said yields are just an expression of future growth and inflation expectations. When you look at these two charts, you see that basically there is a strong relationship in between GDP and inflation reads, right? But most importantly, as you can read in here maybe, right, you see that long-term averages for inflation are around 2.4%. And if you zoom in on this chart right here, you see that basically what we're doing now with inflation as measured by the CPI, which again, by the way, it's a completely faulty measure. All right, I totally agree with that. It's not perfect. It probably, and well, should I say, most definitely, it actually underestimate the real rate of inflation. All right, we can all agree on that. Still, it's the best we got. The market needs at least one metric to base decisions on, right? Doesn't matter if it's not the most perfect metric you can find, but at least it is something. It is a point of reference. It's like I was having this conversation throughout this week about what is currently going on in society, geopolitics, and whatnot. And I defaulted back to Winston Churchill when he was saying democracy, it's not perfect. Actually, democracy is a terrible type of a system, but still, it is the best we got. So it's kind of like the same with CPI. It's not perfect, probably it's terrible, but still the market needs something, and the market will try to get data and reference points from the best type of metric it can get, right? So which is why we are so focused on the CPI. But getting back to this chart right here, you see that if we keep on respecting long-term averages type of values, we should come back to a 2.4% rate of inflation over time. And if you know that the rate of inflation is particularly correlated with GDP, that tells you that economic growth should slow down. If economic slow, I'm really sleepy. I'm really sleepy tongue. If economic growth is slowing down, therefore inflation is going down, the Fed has all the reasons to keep on lowering rates, and there is this inverse relationship in between rates or yields and the price of the underlying assets. So bonds should keep on going up. Now, the point might be, if you really want to find the flow in the argument, is a lot of what was kind of priced in a lot, a lot of the magnitude in the move that you could expect from bonds was already priced in ahead of the cuts. Totally agree. So the point is now, if they keep on cutting, and let's say the terminal rate might be around 3%, 2.5%, all right, then you don't have a lot of additional appreciation in bonds prices. And if they cut really aggressively down to 1% or below 1% because we got some sort of a recession, maybe in 2025, then at that point, bonds price appreciation should be really huge. So, well, where I'm kind of holding my ground is that I think no matter what, there is still a little bit of appreciation in bonds prices. So I'm still holding it. at least the, what remains of that. Because if you look at these, for instance, if you look at PCE as a percentage of GDP, right, versus the overall debt that households have, uh, you see that basically what this chart shows you is that if you go back to the 70s, you see that basically households took on more and more debt, all right, and therefore PCE percentage of GDP went up, all right, but at the same time, by doing so, the amount of debt that was upon those households went up and up and up and up. Now the problem with these, when you have an economy, it's not called debt-based economy for no reasons, right? You need more debt in order to generate more growth. All right. The problem with that is that at the same time, debt is a little bit of a drag on future growth because think about that. If you have more debt, a lot, or at least an increasing part of your future, let's call it revenues or income or whatever, it's going to be allocated to pay down the debt that you already have plus interests, right? So you're going to have over time less and less available income or revenues or money or cash flow to be spent in further productive investments, which is why debt is a drag on economic growth in the future. And you can see that basically the way that went up and up and up translated in this little bit of stall in PC as percentage of GDP going up. We basically stopped around the mid 2000s, or should I say, to 2009, 2010. Hmm. Should this be a coincidence that they stopped going up after the great financial crisis? But well, maybe not. The point sticks that it's really hard to keep on generating further economic growth if you are dealing with that amount of debt. All right. So again, if you forecast slower economic growth into the future, and yields and interest rates are a function of future inflation expectations and economic growth, naturally you should expect inflation to come down and yields to follow. All right. The big caveat, because with every thesis that you need to have a point of invalidation, right? So the invalidation for that and for the bond trade is if we get back to the COVID, the pandemic playbook, where the government is sending checks to households, that's where the bond trade goes up. At that point, there's no point in holding bonds, right? Because if you restart sending checks to households, you're gonna have inflation again. Uh, but other than that, I think we are not predisposed to get inflation. And even if you look at the technology, now we are talking a lot about AI and whatnot, but if you look at technology as a whole, technology is massively deflationary, is a massive deflationary force. Think about everything. Think about all the inventions, all the industrial revolutions. Every time you go a generational leap in technology, that brings you more efficiency. More efficiency brings you less waste of resources, of time, what have you, which makes the stuff that you are producing cheaper. So technology is a hell of a lot of a counter to inflation because technology seek efficiency, and efficiency brings you shorter time of production and lower cost of production. So price should move lower, not higher. The only reason we got inflation and prices, it looks like everything is going up every single year. It's because we are allowing the government to step in too many times and too much. And the government surely it's not seeking efficiency, right? It's not seeking ways to do things in the most cheaper way and maximizing you know effort to returns, right? Because they don't need that. They don't need to generate revenues. They can't go bust. They can print all they want. It's like what we were telling about when it comes down to the NFP reports. jobs added by the public sector versus jobs added by the private sector. There is a huge difference when it comes down to the goal-oriented process, which brings you to hire more or less. It's kind of the same with technology versus government spending. So, which is why I completely hate the government interventions in the economy because they lead to all these distortions, and you could completely avoid them. And over the long run, having a much better, wealthier, and organically growing economy. All right. So a little bit of a tangent there, but at this point, I guess you know me. That's kind of my thing, right? So again, if you look at the stocks, equities sector is going up, right? There is no reason yet to be bearish the stock market. Then again, if you want to go and short the stock market, be my guest. As a general rule of thumb, I don't like to short bull markets, right? You would like to belong in bull markets, right? It's way easier, right? Trend is your friend until the end of the trend. Yeah, this time I nailed it without a slippery tongue. So I continuously brought up uh, bearish arguments, or at least, warning signs and signals about these and that, about the fundamentals. But I've always said, if the market goes up, you need to trade the market you have. Will it end at a point? Yeah, everything ends, right? Life itself ends at a point. So be it. What you're going to do about it. The point is that you can't really fight the tape. If the tape is to the upside, you need to trade accordingly. Uh, Imagine all these people which, just in terms of opportunity cost, lost so much not being invested because they thought, yeah, but in 6 months I think this is coming, so I'm not willing to invest right now. Oh, well, the market went up. Yeah, yeah, it's going up. But I have looked at this and that, and I think at a point in 2025 we're going to have a recession. Yeah, fine. Look, I've been victim of that too. I fell for it too. And you know what? There's nothing wrong in being wrong up until the point you actually learn your lessons. Uh, you can make a mistake one. The whole point of making a mistakes, it's learning from them, right? So uh, again, just stop calling tops and bottoms. Just stop being bearish something just because you want to fade that, because it sounds smart, right? And I guess the the problem, the perversity of these dynamic in people, psychological dynamic of wanting to be right when it comes down to call a top in the market, it's just because you sound smart. It makes you feel good being the hero and one of the few which is actually making money while everyone else is losing them. The problem with that is that more often than not, you're actually gonna lose money doing that because statistically 70%, 75% of the time the stock market is going up. So it would be much easier to just ride the trend to the upside instead of trying to fade it every single time in order to be the hero. Over the long term, that is a losing strategy. All right. Oh, by the way, on this topic, I just wanted to run a little bit of a social experiment. And since we are now more than 40 minutes in, I actually can't reveal it. I'm sorry. It's not meant to pick and to mock on people, but I've just noticed looking at my videos, previous videos, that those with a really bearish thumbnail, they tend to get way more views. While when I had a thumbnail which was neutral or maybe bullish, there wasn't that much of an interest. Again, it might be for the same dynamic. Bearish arguments and narratives are always more appealing, right? So even if at this point you're already seen it, the thumbnail for this video is going to be these. And as you heard so far, although I laid out a few potential risks way ahead into the future, but right now I'm currently still bullish. I want to put that on and see and compare the views that this video is gonna get to the views previous videos with bearish thumbnails had and previous videos with bullish thumbnails had. that that's it. A little bit of a joke, right? But I was just trying to prove a point. Maybe just only to myself, but yeah, just at least now you know. Assuming you already cut the video after maybe 10 minutes, I don't know. Again, when it comes down to the cues and to SPY, it's just going up. It's way above the 20 days moving average. We completed this cup and handle type of a pattern. We broke out, we retested the breakout point, and now we're going higher. So I, technically I don't see any reason to be bearish at the current moment in time. There is still this tiny little factor about the Nasdaq being the lagger. I would much prefer to see the Nasdaq leading, but hey, you can't deny market structure. You can't deny the current trend, right? And if we have a look at the sectors these past 5 days, you see actually technology did particularly well. All right. Now again, bear in mind we are still in earning seasons, so corporate share buybacks are currently off. But as soon as we get off of earning seasons and those buybacks will come back, you're going to have another, additional demand in the market because we already talked about uh, how how much demand is brought in by buybacks alone. And I mean, if you don't remember that, let's see if I can quickly recover that screenshot I had. Looks like I can't, most likely. Yeah, I have it. There you go. This is it. You can see the amount of demand for equities when it comes down to buybacks, right? It's a huge driving factor for demand and therefore for price. So just be aware of that. There was this topic about election risk, and a lot of people might want to do risk ahead of the elections. Historically, that is something which happened. It doesn't look like it's happening right now, so I think one of the main reasons might be this sharp drop to the downside we had throughout August with the yen carry trade unwinding and whatnot. I guess these basically washed out a lot of over leveraged type of guys. So it's kind of like these um, de-risking, deleveraging actually happen for other market dynamics, and you might not have a lot of extreme exposure to the upside right now. So I still consider a little bit of a risk there, but I might say compared to what it could have been, maybe we worked out a little bit of that potential downside due to election risk, right? As a final note on the elections and on what they could mean in terms of price for markets, everyone is trying to predict who's going to win because based on that they can extrapolate the results of the policies they want to implement, each one of the candidate, um, and the impact that those policies could have on the market. I think, first of all, not not everything which is promised throughout the campaign is actually delivered after you get into office, right? But the critical point for me would be not really who's going to win, but I guess you should be focused on the House and the Senate. Because think about it. If you got a situation where, I'm just picking one of the two as an example, right? Let's see Harris wins, but the House and the Senate might be, you know, weighted toward the other side. Maybe you got the majority of the House and Senate being red. At that point, it's going to be particularly difficult to pass any bill because the administration might have some ideas, but then they can't go through the House and the Senate because there is too much conflict into it and not enough support to the current administration to actually pass those bills. So in that case, I think a lot, I'm not saying everything, but a lot of the status quo when it comes down to the policy and regulatory framework would remain the same, or at least you could expect that to remain the same, if not moving and changing particularly slowly. That, to me, would be a situation where the market could be happy because they wouldn't have to price in the policy risk due to the actual changes in policies. On the opposite side of it, if you have some sort of a take it all type of a win from one or the other when it comes down to the candidates, right? And it's going to be a situation where the administration could pass bills very easily. Then it's where the market needs to adjust and reprice policies, which at this point could be much easier implemented and passed through and actually came into effect. I think that could impact markets more when it comes down to managing the risk and therefore the risking and whatnot. So that would be my take on it. Other than that, I don't know who's going to win. I don't think, again, it is particularly crucial. Um, if not, when it comes down to how the House and the Senate might be splitted. Overall, I think whoever is going to win, the, I mean, you can have your preferences, right? I'm a human being. I surely have mine, although the United States are not even my country, so why should I care? You might say, I just have a preference. I'm not going to discuss that here, but I say overall, whoever wins, the results might probably be the same in the sense of more government spending. All right. And I don't really think, or I read a little bit of the programs they had. I don't really think that what they are proposing is actually gonna solve the fundamentals issues and the long-term issues that the country is actually suffering right now. There is too much to be discussed there, I think, and I don't think the problems that you as Americans that you got. I'm not saying we don't have problems here where I do live in Italy, but since we are talking about America right now and U.S. markets for the most part, I don't think that electing one or the other could really change the landscape overall, both from an economic standpoint, from uh, the social aspect of it. I think there is much more to it than what you could extrapolate uh, by just looking at the elections. It would be a long-term process which would require a mental shift, not in the, you know, political type of elite, but I think it should be built up, bottom up. And it's the same kind of in all Western civilizations at this point, I think. The change needs to come from the bottom up. Otherwise, we are always going to get the politicians we deserve, right? Just a, just a little bit of a food for thoughts there. Uh, Independently, regardless what type of political view you got, right? Just think about that for a minute. So, overall, think this might be a good spot to leave you off, and we'll see what next week's gonna bring. Don't have anything else to say. I think that's for the better. So, as usual, have a nice rest of your Sunday. And coming into next week of trading, just be nice and be cool. Neil's out.